Hi, I'm Jim Gordon with another edition of Small Cap Interviews on location at this year's Vancouver Resource and Investment Conference. Our next guest is a public speaker, a veteran investor, and he's also the president and CEO of Rule Investment Media. Rick Rule is in the spotlight next. And Rick Rule joins us now just across the street from VRIC, which is taking place. Rick, it has been a year, literally a year since you sat with us. Welcome back.
Pleasure. Thank you for having me back.
You're quite welcome. Lots to talk about. Let's first, as I said, you've just come over from a very busy VRIC. Your thoughts and impressions, very busy this year, which is great to see.
Everything's better this year. The crowd is better. Jay's done a great job with the conference. The presentations are better. High quality of exhibitors. The tone, I think, is better.
Okay.
When they talk about the malaise, particularly in the junior markets, that malaise is not evident next door. Whether that's a harbinger or whether you're in a Christian choir asking people if they believe in God is an open question. But the truth is that both the size of the crowd and the tenor of the crowd is very different this year.
Can you talk to, I mean, as I said, it's been a year, lots has changed, lots of stuff coming in as we're at the time we're doing this interview. Can you sum up or talk about what's different, say, between last year and this year in a broad general sense?
I think that the overall tone of the market is improved, but I think that the market is still, at least for the quality names, reasonably priced. In other words, for people who are concerned about the fact that they missed the boat, the disconnect, as an example, between the oil price and the price of oil stocks, or the gold price and the price of gold stocks, is still attractive. I think, too, that there are some particularly attractive sub-themes that are out of the way of the market, that the market isn't paying attention to. And my suspicion is that if we have market strength, that the market will rotate through sectors as they're undervalued and reprice them. So I'm looking forward to, 2 to 5 very good years.
Okay, yeah. You
know, I'm 72 years of age. I don't have to be here anymore.
Okay, you're looking at that realistically. Okay. There's some other things I want to talk about. Let's talk about some of the themes you want to stress while we're talking with you in this interview.
Well, I think the easiest theme for this audience is Canadian oil and gas.
Yeah.
I think a lot has changed for Canadian oil and gas, and it's changed for the better. The market is acting as though it's changed for the worst.
Okay.
And finding a broadly held theme that's wrong and betting against it is how Soros became a billionaire. I'd like to emulate that.
Okay.
I think a second theme is that not so much the narrative, but the arithmetic around gold ownership is very, very, very good. I think a lot of people own gold because of past performance without knowing why. And I think if they knew why, they would do better. We're in a wonderful market in the small and mid caps in that the market has been in malaise for 5 years. That means two things. You don't have to compete with a whole bunch of people. Stuff is cheaper when you don't have to compete. But more importantly, it means that there isn't very much price discrimination between good companies and bad companies. You can buy higher quality people for effectively the same price that you pay for, the Three Stooges.
Right.
Which is really good.
Yeah.
And the fourth theme to me is that in some out of favor commodities, there are some potential tier one deposits with 10 or 20 billion dollars in situ recoverable reserves and resources, projects that would be in the best cost quartile worldwide. And these companies are selling at substantial discounts. If those commodities return to favor, you're talking about in some cases, probability of 10-fold or 15-fold price increases in the 5-year time frame. And these things are at knockdown, drag-out prices. Admittedly, in difficult jurisdictions, in commodities that people don't care about, but that's where you make money.
Right.
You make money by getting in front of the crowd. And the opportunities to do that today are, at least from my point of view, extremely attractive.
Let's talk about you said to me, I want to talk about the arithmetic word I haven't used yet on this on-location shoot. Arithmetic of the gold trade.
Sure. If you study gold, and I've been through 50 years of its history myself, but I've studied it. What you find is that gold really moves when savers are concerned about the maintenance of their purchasing power.
Right.
In savings instruments that are denominated in fiat currencies. That's where arithmetic comes in. Right now, in the United States, a market I know better than Canada, so we'll talk US numbers. Sure. The on-balance sheet liabilities of the US government, which is to say the debts to bondholders, are $36 trillion. That's a big number.
Yeah.
That number, rather than getting better, gets worse by $2.5 trillion every year. To put that in reference, that accretion of deficit, $2.5 trillion, had it been paid, would have been half of gross federal revenues before the government paid any money for anything else. So let's put that aside, because it gets worse.
Yeah.
What people don't pay attention to is the net present value of unfunded liabilities. The Congressional Budget Office, not some cranky old libertarian named Rick Rule, but the Congressional Budget Office will tell you that the net present value of unfunded promises to Americans, Medicaid, Medicare, Social Security, federal pensions, military pensions, that number is $100 trillion.
Wow.
And that number gets bigger, according to the Congressional Budget Office, again by $2.5 trillion a year. So every year the United States gets deeper in debt, $5 trillion. Set that number aside, okay? This is a math lesson.
Yeah, yeah.
The Internal Revenue Service of the United States says that the private net worth of American citizens is $141 trillion. So here's the math question. 141, which is what we're worth, and 136, which is what we owe. That leaves $5 trillion left over in net worth over obligations before you auction off federal land, which they're not going to let you do, okay? Now that $5 trillion matches both the increase in liabilities every year and the gross federal revenues. That's the top line math. What that tells me is that our benefits package is unsustainable. We faced this in the United States before in 1970. And the way we faced the problem, we couldn't raise the tax and we couldn't cut the benefits. It was politically infeasible. So what we did is we reduced the purchasing power of the US dollar via inflation. We honored the nominal obligation. Some old codger who was then getting $400 a month in Social Security continued to get it, but it only bought $100 worth of goods and services. According to the Office of Management and Budget in the United States, the purchasing power of the US dollar in the decade 1970-1980 declined by 75%.
I didn't know that. Wow.
And lo and behold, the gold price went up from $35 to $850.
Wow.
That's the arithmetic, but there's one more piece of arithmetic that almost guarantees, I think, my thesis, and that is this. The government would have you believe that the correct way to measure the purchasing power deterioration of the US dollar is the CPI. That's their consumer price index. And if you believe that number, you believe that the purchasing power of your US dollars is declining by 2.6% a year. But use your common sense. First of all, the CPI is a cost of living index. When it's inconvenient, it doesn't include food or fuel. Full body shot, any index that doesn't include lunch is of no use to me. Doesn't reflect the way I live. The CPI doesn't include tax either. It doesn't include the largest household expense for most American families. If your listeners, the people who are listening today, think about the escalation in the price of goods and services that they consume in the period 2000 to 2025, the price of gasoline, the price of tax, the price of groceries, the price of health care, the price of health insurance. John Williams, who does shadow stats, suggests that the purchasing power of the US dollar is decreasing at 12% a year. I believe it's decreasing at 7.5% a year. So here's the next piece of math. You're a saver. You put your money in the US 10-year Treasury, the world's benchmark saving instrument. They pay you 4.5% in a currency where your purchasing power is declining by 7.5%. In other words, you have a US federal government guarantee that you will lose 3% of your purchasing power every year for 10 years. We said at the beginning of this talk that gold has done well when people are concerned about the maintenance of their purchasing power in US dollars. And it's guaranteed.
Well, and you mentioned going back to 1970 and that decade when you said gold got up to 800, 1970s dollars. Can you give us your thoughts on gold price going forward? We're talking 10,000?
I mean, I'm too old to give you a price target. What I'll say is this. When people say, Rick, do you think that gold can get through 3,000? I couldn't care less about the move from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 9,000 or 10,000 or 12,000. The circumstances that cause that to occur are fairly unpleasant. I would prefer to be wrong. I'm 72 years of age. My lifestyle's very good. I would prefer it not to be altered.
Right.
But since I think it is going to be altered, I feel the necessity to defend my family's purchasing power and my purchasing power. And there's a time-honored way to do that. Not going back 2,000 years, but rather going back to when I came in the business in the 1970s. And that's with gold. I don't own gold because I think it's a great trade. I own gold because I think it's insurance. I own gold stocks because I think I'm going to be right about gold, and that's going to be manifested in the gold stocks.
There's a lot of arithmetic. Thank you very much. Let's talk. You do something that you mentioned before we went on camera, and that is portfolio reviews. 100,000 you have looked at?
About 100,000. I haven't counted them individually. I've been doing it for 10 years.
Yeah.
It goes like this. Anybody who sends their, including these listeners,
yeah.
Anybody who goes to ruralinvestmentmedia.com and lists their natural resource stocks, I rank them 1 to 10. Now, there's 3,000 resource stocks in the world. We follow 820.
Okay.
But anyone we know will rank, and we'll comment on individual issues if we feel our comments might have value. The benefit to me is I've gotten to learn an awful lot about how people invest, what they get right, what they get wrong.
Yeah, I wanted to ask you, I'm
Over
very
10
curious,
years.
the consistent thread through good and bad. Can you give us some
This
thoughts?
business, natural resources, extractive industries, are capital intensive and cyclical.
Mm-hmm.
To make money, you have to be a contrarian, or you're going to be a victim.
Right.
But most investors aren't contrarian. When uranium is at 20 bucks a pound,
right.
and it costs the industry 60 bucks a pound to make it, when the price has to go up, nobody wants to buy it.
Right.
You tell them the narrative, but it doesn't matter. They're either afraid of it or they're bored. When the price has gone from 20 to 60 or 70, it doesn't have to go up anymore. Everybody comes in the trade. Happens again and again and again. So the first lesson is, you are either going to be a contrarian or you will become a victim.
Right.
The choice is yours. You have to buy out of favor. Warren Buffett says, buy straw hats in winter. Wonderful illustration. Fidelity, the big mutual fund group, they sliced and diced their customer base by ethnicity, age, sex, race, and they tried to figure out which subgroup at Fidelity performed the best over 10 years. You know what subgroup performed the best?
Let me hear it.
Dead people. People who didn't trade, people who didn't chase fads. Okay. I mean, it's an amazing testament to the way that people invest.
Yeah.
That estates, unmanaged accounts, did better than accounts that were actively traded. The lesson there in natural resources is that A, you have to be a contrarian, and secondly, you have to invest in companies that are good enough that time is on your side. Many natural resource investors, including, I'm assuming, some of the people who listen to you, have very good long-term narratives. They have very, very, very good strategies.
Right.
But they have 3-month tactics.
Right.
If you're investing in a 5-year thesis and you have a 3-month orientation, you've set yourself up for failure.
Right.
So the two things that I've learned is that people chase fads. They accept narrative after it's been proven in the market where the narrative's no longer value. And they've done so little work understanding what they invest in that they get shaken out of the trade in 2 months or 3 months or 4 months, when the very trade itself is assuming a 3-year narrative or a 4-year narrative or a 5-year narrative. Those are the biggest lessons that I've learned looking at 100,000 portfolios over a decade.
This is fascinating stuff. And people can do this, Rick, as you mentioned, by going to ruralinvestmentmedia.com?
Absolutely, and please, 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 no tech stocks, no pot stocks, no crypto. Right, I don't do those.
No, I appreciate that. Also, at Real Rick Rule. It's always a great pleasure to talk to you. We only seem to do it once a year, but I appreciate you giving us time from a very busy VRIC. I said to you last year, one of the very first things I read about you, which I loved, was looking at investing like shopping at a supermarket.
Correct.
That's fantastic. That really simplifies it for people like me. That's brilliant.
Right.
Rick Rule here on location at VRIC, another small cap interview. I'm Jim Gordon. Thanks for watching.